Hello, good morning. My name is Lidan. I'm the second author right there. This is a joint work between Anton and Se Huang. Se Huang is sitting over there. She's from Manchester, University of Manchester. I'm from Düsseldorf, University of Düsseldorf. And Anton, when we wrote this paper, he was in IEEE. Now he has set up a new firm. He's not here today, Flow of Technologies. This idea actually came from him and his then co-founder, founder of IEEE, Richard, I think. Yeah, he's mentioned some problems that they have when they were. He was a high-frequency FX trader, and then went into this using cryptocurrencies to trade FX. So he mentioned some problems that they have, and so this kind of developed into a paper, so like how we can solve their problems. So I will explain a little bit to you how the motivation of the paper, and then how we try to solve the problems. And if you have questions along the way, just feel free to ask, because we have a lot of time actually today, I think. Yeah, what he told us was that because a lot of these trades today, they are increasingly done in very, very short time spans, right? So he told there are almost more than 90% of currency positions are actually held less than 24 hours, and many of them are only in minutes or in hours, right? And then you have further advances in fintech. So you have that allows you to trade, and then now with blockchain settlement, you can settle it immediately, right? So you can do this within 10 minutes, right? And clearing, it's all done together and within seconds. As technology goes further, we expect it to be done even quicker, right? So you have high-frequency algorithmic trading and settlement that is done 24 hours globally. It's no longer limited by these borders, and it doesn't go through central banks anymore, right? So, and then with this disruption, technological disruption of the blockchain, so you can have immediate settlement. And so then these FX traders, they actually require a much far shorter tenor interest rate curve, right? Then now, right at the shortest end is 1 day, and it really is no longer applicable in today's financial world anymore, right? Our present financial system follows the time. It comes from a time when in the past, when pieces of paper had to be verified and processed at the end of the day. I remember 10 years ago, I was working in the bank, and it closes at 4 o'clock. I come from Singapore, right? I was working in the bank, and they close at 4, and then they start to process all the trades and the loans of the day, and you really have pieces of paper moving around. I mean, there's some of it on the computer, and then they really have a whole department doing it, right? And it's going to change, right, if with all this technology. So, and those days, if you really use the old way of doing things, right, it doesn't recognize intraday trading, right? It only recognizes at the point when you cut off at 5 o'clock whether interest rate is paid or not, and it ignores like 90% of the trade. So, it's like using old plaster to stick new wounds or something like that. It doesn't really work anymore. So what we are proposing is that we want to try and estimate what kind of intraday yield curve or interest rate curve or a high-frequency trader actually face if they want to settle on blockchains, all right? And we have to derive these yield curves, right? And we try and base it on the exchange rate dynamics and also on uncovered interest rate parity. So after we estimate that, we find that if for the yield curve that we obtain, we find that for assets actually held intraday in less than an hour, the shorter it is, it actually deviates very substantially from the daily overnight rate curve. All right, and we show that if they had used these kind of curves, right, it will really help to stabilize currencies. And I know Anton is not here, but he was actually a flash crash expert, so he was into this when we were students. Yeah, so it's something close to him. Yeah, these flash crashes, right, they actually can cost a lot of money to the economy. And we show that by using these kind of intraday yield curves, it will actually help to mitigate these the effects of these flash crashes. Right? They'll try and swing the currency back to stability much quicker. Okay, so I'm going to talk to you about some literature. Right? I actually already discussed the motivation, why we want to do this. I'm going to tell you some literature that has been done in the past. There's not much on this area. And I'm going to tell you how we actually try to estimate this yield curve. And then we're going to apply it on the Swiss franc event on 15th of January 2015. It's when the peg to the euro was released, right? And we see there was a flash crash at that point at 9:30 when they announced it. And you want to apply at that point using high-frequency data and see if they had, the yield curve at that point, how would it have looked like if there were such yield curves. And then we conclude and think about what kind of implications or what kind of improvements we have to make. This is actually, Anton was supposed to explain this, right? Before I started this, I didn't really know a lot about blockchain technology and all that. But he was in Likey, and they were, I don't know if there is a pointer. There is no pointer on this. Okay, sorry. What you see is that the traditional way of making trades, right? You have trading, and then you have clearing, and then you have settlement. And you have a lot of parties involved in this, including settlement agents, brokers, custodians, and it is actually quite expensive if you think about it. So the distributed or blockchain technology allows you to do it all within with just a trading venue, so an online trading venue. So in our paper, the example was with Likey. So you have only two parties, a distributed ledger and a trading venue, and you can do the trades with a lot less parties involved. And this really cuts down settlement clearing costs tremendously, and also the time. So if right now, if transactions on the blockchain, if they attract interest rates, then if they want to pay interest rates, then they will be actually then maybe held for the interest rates for the duration that is held, so a fraction of the business day that it's held. Right, of maybe that fraction of the daily rate or OSS swaps that actually fluctuates intraday. But it doesn't really account for the demand and supply at the very point in time of the very short borrowing or lending time. So it is not really adjusting. So there were 3 papers that we found that were a bit related to our research. The first one was Bagliagnoli and Monticini. They saw that they tried and examine the pattern of intraday OIS rates, and they showed that during a liquidity crisis, these rates actually do jump. All right. It actually debunks the idea that interest rates are actually slow moving. Actually, it does jump. I mean, the theoretical rate actually will jump. In an older paper, and they examined Lyons and Rose in 1995, they examined the UIP at high frequencies also at that point, and they showed that if you do not compensate investors by these, because there are no interest rate differentials, they are really stagnant, so that's why when currencies are under attack, they actually fluctuate a lot. They're very unstable during attacks, and it's completely absorbed by the currency movement. And then a very important paper was by Chabot and Wright, 2005. I mean, as economists, we know that UIP very often empirically does not hold. But what they saw was that it does hold when you at extremely short periods of time when you pay interest rates. So the argument was that because 90% of them don't pay interest rates, so UIP doesn't really hold, uncovered interest rate parity doesn't really hold. But if it does, if we pay interest rates, then the UIP would hold much better. So what is the UIP here? So it is very simple, right? It's actually the expected change in exchange rates, and exchange rates, yes, it's equivalent to then, I wish I have a pointer, the differential between interest rates between two countries, and then risk premium, that the pi. And this pi is a time-varying risk premium, and then we have, and because of the expectations, we have a kind of error term, that is IID, random error. And so we apply the UIP to forecast the yield curve at time t. If you're standing on time t, we want to know that at that point, intradaily, the interest rates that the person is going to face in the next few hours, minutes, and seconds. Yes. Oh, thank you very much. Yeah, thank you. Yeah, so here we have the risk premium, time-varying risk premium, and we try and project, right? We need to forecast this RT in order to find this intraday interest rate curve, interest rates here. All right, so the foreign interest rates, and this is the local, domestic interest rates. Okay, so you need, we want to make them intraday. All right, so following, now how do we forecast these rates? Now I have here an older paper by Engel and Russell and Engel where they have this model of irregularly spaced FX returns. So you forecast this irregularly spaced of the durations and multiply it by the returns. In the beginning, we tried another, last year, we tried another model, a newer model, using simulated methods of moments by Feng et al. And that was a problem because they had a lot of parameters and a latent variable, and we found that it was not very stable. It was very subjected to the starting variables. So in the end, we decided to make it all completely observable process, right? So we just make it that there are two sets of processes, random processes that you have to model, the durations and the returns, right? And the returns are also a function of the durations, all right? And it's completely the model from Engel. Empirically, it's a puzzle why it doesn't hold. And it doesn't hold, the argument by Chabot and Wright doesn't hold because it does hold when you pay interest rates. Yes. Okay, so to model the durations, we use Bowen and Georg's log ACD model. It's just simply so it's the ACD, the autocorrelated conditional durations model. The contribution here was to put the logs here, and they found that it performs better, but you can also make different ACD models by having different variations of this. Okay, but we followed the paper, and we modeled the durations with this is the conditional expectation, the log conditional expectations of durations. And we just make it an AR model. And for returns, we have ARMA, a high frequency, ultra high frequency ARMA gauge model by Engel. So with the adjusted returns divided by the square root of durations, have a simple gauge process. Right, so this is the ARMA model, where it has a conditional variance with a gauge x. The x here is inverse durations. I don't know if any of you have seen an earlier version of this paper. It was actually, we first assumed a normal distribution for the errors, but Se Huang presented this paper 2 months ago, last month. Yeah, and there was a suggestion to use t-distributed errors. So now we let these errors be skewed t-distributed. I'll talk a bit about the results later. So what we did was we estimate the model at time t, if you are standing at time t, and then we use the last 1,000 code observations when you're standing at time t to do the calibration, so you estimate all the parameters. And then we use it to simulate the next 5,000 steps ahead. We simulate the durations and the returns as well. All right, and we can repeat it 1,000 times. We take the average, and this is our forecasted curve. Right, and if you have UIP here, you have then this estimated forecasted returns. And then if you have one side of the, let's say the foreign interest rates, right? And then you can kind of estimate the domestic, what the interest rates at that point at time TK would be, right? And this is your risk premium. It's a fraction of the business day, all right? Okay. And so N is the 5,000, the irregularly spaced codes in the forward time period. Yes, yeah, I'll talk to you. Yes. I first removed the, yeah, I'll show you. Okay, I'll finish the methodology before we come to the data. Okay, so from UIP, where if you have known the foreign interest rates, and then you can infer the domestic interest rates, and vice versa. And then finally, we smooth the curve, right? We fit the Nelson-Seagull interest rate model curve, right, with the whatever we simulated, and to produce a kind of smoothed curve. And where we fix, now there are several parameters here to estimate. So there's beta naught, beta 1, beta 2, and tau, all right? Beta naught is a long run levels of interest rate. Beta 1 is the short end component, beta 2 is the medium component, and tau is a kind of a decay factor, which actually kind of determines your turning point of the curve. What we do was that we fix the long run level of interest rates to the daily interest rate. So we don't estimate beta naught. We let it converge to the daily rate. So your intradaily would converge to a daily rate by just fixing the level. So now we're going to apply it to this event on 15th of January, just before and just after, and we see how it looks like. On that day, at 9:30 a.m., Swiss National Bank, they announced that they're not going to hold this peg anymore of 120 Swiss francs to the euro. And just at that point, they also announced that they will lower interest rates on sight deposits to the negative rate. And this announcement, they caused a 41% appreciation of Swiss francs in 20 minutes. And there was all the automatic liquidity providers, they withdrew from the markets and suspended streaming prices on multiple platforms. In Chicago, Mercantile Exchange, they issued a trading halt. Okay, and then the flash crash was more severe. I'll show you a picture of it. So at this 9:30 a.m., there was a huge shock here. This is the return series of Euro CHF rate. There was a huge shock here, and you see here this is the mid FX rate, so the middle of the bid and ask. So it just crashed very steeply, appreciated very steeply before getting a bit more stable here. And if you look at the liquidity, there was a shortage of liquidity at that point. The bid-ask spreads really rose a lot, right? And then it kind of stabilized a little bit down, and then it was another peak here, right? And then you see, this is like if I stretch out the time, the announcement at 9:30, if this is to 10, it was going, if I open up this area, I just stretch out the time, you notice that it's a slope going down, and then before it stabilizes a little bit here on this level. So how we estimate the risk premium, the pi factor. We use a time rolling window to estimate the time pi. And you can see that already from 2013, it's already going downwards. And then before the crash, it goes very, very steeply down, the risk premium. And then it goes up again. But because we remove the effect of the crash here, so you see another red dotted line going upwards. Yeah. Because this is because of the rolling window, it's causing this huge, the shock on that day of the crash. Yeah, and then here it's coming out. So we're going to use the red line as the risk premium of that day. So whichever day we are choosing, this is our time varying risk premium estimate. And this is your question about seasonality. So before you have the raw data, we clean the data by removing we let it be 24 hours FX trading, but the weekend, because there's very sparse data, we remove those. And then we, for intra-second trades, we round it up to the nearest second. And then after that, we apply a seasonality correction. So to fit the model, you have to remove the seasonality, so intraday seasonality factor. So this is that for durations, and this is the seasonality factor for volatility. And after we do the simulations and we forecast the 5,000 ahead, then we replace back the seasonality factor. Okay, this is just about the durations on that time. On that day, 8 o'clock in the morning, so you see this is the log number of trades against durations. I just want to have a look at the data, right? At 9 o'clock, it's still before the announcement. So you see it's relatively spread out to 14 seconds. And then once after the announcement, you see that all the durations are pretty short here. Okay, there is a huge concentration here. And then it slowly, the curve slowly goes a bit flatter towards the rest of the day. Okay, so
1 hour, how many trades occur within like 1 millisecond of each other?
yes.
And the units are taken 5 seconds?
Yes, seconds. Yeah, I know you don't like numbers and tables, but here is our estimates for the log ACD curve, and this is the UHF, the GARCH. So these are the ARMA parameters. Kappa is the ARMA X parameter, is duration. This is your standard GARCH, omega, alpha, beta. And this is against the GARCH X for 1 over durations. This is our addition this month. So we have the skewed T. This is the skewness parameter, and this is the tail parameter, so how fat tail it is. So at the crash part, it does get very fat tail. What you also noticed was that after the crash, it became very non-stationary, the GARCH here. For us, we found that the durations were pretty well modeled using the ACD model, log ACD model, but GARCH, there were several times when there were no significant parameters at all. So, yeah, this is a problem. And then once you have a crash, it became non-stationary. So you see that the alpha and beta adds up to more than 1. Why don't we could use. No, but it doesn't forecast returns. They are forecasting volatility and volatility. Yeah, exactly. They have like 5 minutes realized volatility, and so you have a fixed number of durations. But we want to model this irregularly spaced return and time in future, because time in here is quite important because it's interest rates. If you have fixed space, then it kind of defeats the purpose. We want to know how much interest rate you pay if you like hold this for 3 seconds or 2 minutes or something like that. You know what I'm saying? Okay, these are the Nielsen-Seagal parameters. So the beta naught is fixed at the level, the day overnight rate. And then you have beta 1 is the short parameter, short term, where you see at the crash, it changes dramatically to very, very negative. And then beta 2 and and the tau parameter. I'll show you the curves, maybe that's a bit more interesting. So this is on 9th of January. This is before the crash, right? So what we found was that on the usual days, they have a kind of a U-shaped curve intraday. So you see here, the scale is 25,000 seconds, is about 3.5 hours. And then it will just continue converging towards the daily overnight rate. So this is the black line is the simulated curves. And I have a red line here as well, it's a smoothing spline. The dotted blue line here is the Nielsen-Seagal interest rate fitted curve. And so you see at 10 o'clock, it's just downward sloping. All right, and this is the 11 o'clock curve. And this is on the day of the crash. 9 a.m. is still before the crash. So it is upward sloping. Somehow there is a lot of liquidity here. And at 10 o'clock, you see a sharp jump in the interest rates right at the very, very small tenor. And then it became extremely negative at minus 25 basis points. At 11 o'clock, it kind of corrected a bit better. And at 12 o'clock, it was very negative. At 1 o'clock, and this is the next day, 8 a.m. Now, I think I cannot really explain why it was so negative at 12 p.m. I think the gauge became very, very non-stationary. The non-stationarity was like increasing with time. So this was the peak of the non-stationarity. It was like the alpha plus beta is about 1.8. So it's quite an explosive behavior, right? So if I were to open up the curve here at the very short tenor to see what happens at the very, very short end, like the first 8 minutes, it looks like this. At 9 o'clock, this is the first 8 minutes of the curve. The black line is again the simulated curve, and here is the smooth curves. And you see right at the crash, there is a huge jump in the interest rate right at the very, very short end of the first 1.5 minutes. And then it sinks to a very negative rate for the rest of the curve. So this is what we think as a liquidity premium that at the crash, right, there should be a liquidity premium to provide liquidity if you want to have this kind of. And then the curve becomes very negative to kind of discourage investors from buying Swiss francs. So if this curve had been used during the crash, it would have really stabilized the markets at that point, because it gives the liquidity providers a huge incentive to continue trading. And then it will also disincentivize people from buying Swiss francs to stop the appreciation of Swiss francs so quickly, right? Because of the negative interest rates. Here you see then it becomes again flat at 11 and 12 o'clock. Okay, I'm going to conclude before I maybe take some questions. To our knowledge, this is the first time that anyone ever tries to introduce an intraday ultra-short tenor yield curve. And what we found is that these curves generally are either U-shaped, all right, or downward sloping, and it is consistent with market liquidity provision. It rewards market liquidity provision at the very short end. It discourages very ultra-short-term speculation that increases crash risk. So it just provides an automated stabilizing mechanism during periods of shocks. Things that we could work on, if there is a better model of doing this FX returns, especially during the crash period, that would be quite nice. With that, I'm finished. If you have questions or suggestions on how to because it's at a very, very, very tiny end of only the first 1.5 period. There is a paper by Christopherson in 2006. He also discusses this time-varying crash risk, and he finds that the liquidity factor dominates every other factor when there's a crash. This is the most important. Then it would have, this premium would stretch a lot longer. It's not only holding for the first 1.5 seconds, minutes. Because
So this is like 10 o'clock. If you hold Swiss franc, if you borrow Swiss franc for less than 200 seconds, you have to pay interest rate. But if you hold it for much longer, it's actually negative interest rate. So if you look at the exchange rate movements, so it goes down and it goes up. So one of the possible explanations that fit this pattern is on the way up, people is actually long, at a very short time, long euro. When they borrow Swiss franc to do the reversal trade. So for this, within these 200 seconds, if you recognize that these hunters are doing this reversal trade, you want to charge everybody for having Swiss franc.
That could be the Swiss National Bank intervening.
So you have to have someone constantly buying euro. Yes, it could be the Swiss franc. It could be the government, Swiss National Bank. So the negative rate all the time, in fact, at the beginning, you can see that because of the huge depreciation of the euro, the negative rate is very nice, it's very natural to stop people holding Swiss franc. So our problem now is to fix the normalization.
There's one question.
When you were constructing your model, you said you took 1,000 forecasts on average to get the predicted curve. Did you find that there was a significant variance between how many forecasts you had to go through? So how did you arrive at 1,000 was the sweet spot in terms of developing that model?
Well, basically,
no, we didn't.
this is a time chain. We don't take clock time, we take convection.
We just use the
So
last.
we use 5,000 convection. So basically, this 1,000
Aye.
convection is the quiet time, maybe 3 hours. So for this 1,000 convection as it crash, it comes out maybe 30 minutes or 9. The idea experience is that when the time is convection is very fast, you can reactivate everything quite fast.
For me, I'm thinking about it at a statistic point of view, because you want to use only the last few stuff to estimate the model, and for gauge, anything less than 1,000 observations, the gauge is actually not reliable anymore. So that's why we use the last 1,000.
So I also have one more question, unless there is another question in the audience. So maybe you could zoom out a little bit and put this back into context, whether or not, because right now these trades cannot be made, if I correctly understood that in very short-term trades.
The FX rates are convection.
No, this is a hypothetical curve.
Also, how does this link back, say, for example, to a different part of the feature on a crypto?
Right. We have ongoing work now. We are repeating this work on time.
No, because maybe to link back to your story, because in the crypto world, there's no really a central bank to control anything. And this is a really tool for the central bank to use now. I mean, you have no really control on, you can't say that I close the exchange markets nowadays, right? If your currency crashes, you can't say I close the markets, I halt trading, because people are trading on the crypto world and you can't really control that. But you can control interest rates if you set these interest rates to discourage, then it kind of automatically figures.
It's a very